If you are still asking how to be profitable in 2026, then the first thing you must accept is this. Profitability is not coming from a new strategy. It is coming from removing bad behavior. The market in 2026 will not reward intelligence more than it did in 2020, 2023, or 2025. It will reward discipline under pressure, faster algorithms, more noise, more false information, more fake gurus, more emotional traps. The traders who survive will not be the most creative. They will be the most structured, and structure starts with subtraction. So before we talk about making money, we talk about stop bleeding, because most traders are not unprofitable. They are overactive, undisciplined, and emotionally exposed. Now let's begin. 1, stop trading every day. Daily trading is not professional trading. It is emotional dependency disguised as consistency. The idea that you must trade every day to be profitable is one of the most damaging lies in retail trading culture. Markets do not offer opportunity daily. They offer windows. Institutions do not wake up every morning needing a trade. They wait for conditions. Retail traders wake up needing validation. That need is expensive. In 2026, volatility will be selective. Liquidity will be engineered. Many sessions will exist only to trap impatient traders. If you trade every day, you will trade during manipulation. If you trade selectively, you will trade during expansion. Profitability begins the moment you stop forcing opportunity. 2, trade one direction per day. Indecision is unprofitable. Most traders flip bias multiple times in a single session. Long, short, long, again. Not because the market changed, but because their emotions did. Institutions commit to a narrative. That narrative may be wrong, but it is respected until invalidated. Retail traders change bias because price flickered. In 2026, direction will be clearer on higher time frames and more deceptive on lower ones. If you cannot commit to one directional idea per session, you will be chopped apart. One bias, one narrative, one execution plan. Anything else is gambling with analysis language. 3, accept that drawdown is the entry fee. If you are still emotionally offended by drawdown, you are not ready for profitability. Drawdown is not punishment. Drawdown is positioning cost. Institutions expect drawdown. They design for it. They size for it. Retail traders panic at the first retracement because they believe being early equals being wrong. That belief destroys trades before they mature. In 2026, algorithmic probing will increase. Price will overshoot more often before expanding. If your stop placement in psychology cannot survive normal drawdown, break-even logic will destroy your expectancy. Profitability belongs to traders who can sit inside discomfort without interference. 4, stop reducing risk after entry. This one will offend many. Moving stops to break even early is not risk management. It is fear management. Risk is managed before entry. After entry, the only question is whether the idea is still valid. Reducing risk after entry kills expansion. It teaches your mind to flinch. It trains you to escape instead of endure. Institutions do not negotiate risk mid-trade. They define invalidation and respect it. In 2026, volatility spikes will take out emotional stops repeatedly. Only traders who allow ideas room will capture real moves. 5, trade time, not price. Most traders are obsessed with price levels and ignore time behavior, time of day, session transitions, kill zones, weekly opens, daily ranges. Price without time is noise. In 2026, liquidity will be heavily time engineered. Moves will occur when participation is highest, and traps will be set when attention is lowest. If you are trading randomly throughout the day, you are trading blind. Professional traders trade when first, then where. Retail traders reverse that order and pay for it. 6, lower your frequency, not your confidence. Many traders think the solution to losses is to trade less with hesitation. That is wrong. You trade less with conviction. Fewer trades, higher intent, cleaner execution. In 2026, overtrading will be the number one account killer. Not bad analysis, not bad entries, overexposure. One clean trade per week with proper management beats 10 forced trades per day. Confidence comes from selectivity, not activity. 7. Stop aiming for win rate. High win rate traders are usually the least profitable. Why? Because they clip winners and hold losers. Institutions do not care about win rate. They care about asymmetry. One strong expansion pays for 5 losses. Retail traders try to be right often. Professionals try to be right big. In 2026, markets will trend less frequently, but expand violently when they do. If your system cannot hold runners, you will miss the only trades that matter. Journal behavior, not setups. Most traders journal charts. Professionals journal decisions. Why did you enter early? Why did you exit late? Why did you move the stop? Why did you hesitate? In 2026, information overload will be worse. Chart perfection will be useless without emotional clarity. If you are not tracking your behavior, you are guessing your growth. Profitability comes from correcting habits, not finding patterns. 9. Trade smaller than your ego. Most traders size based on desire, not tolerance. If you cannot hold a trade without watching every tick, your size is too big. If you cannot let price retrace, your size is too big. If you cannot sleep in a position, your size is too big. In 2026, volatility will punish oversized traders brutally. Small size with patience will outperform large size with fear. Scale later, survive first. 10. Stop seeking comfort from the market. This is the root. Most traders want the market to reassure them. They want confirmation. They want smooth moves. They want respect. The market owes you nothing. It pays discomfort. If you need emotional comfort to trade, you will exit early, hesitate late, and revenge trade often. Professionals do not seek comfort. They seek alignment. Alignment with narrative, alignment with time, alignment with structure. Comfort is irrelevant. Now let this settle. Profitability in 2026 will not come from innovation. It will come from discipline, stacked on discipline. Remove noise, remove urgency, remove ego. What remains is execution. Most traders don't fail because they don't know what to do. They fail because they cannot do it when it matters. Execution is not clicking buy or sell. Execution is the ability to act in alignment with your plan while the market is actively trying to pull you out of it. In 2026, execution will be the dividing line. Information is everywhere. Models are copied. Frameworks are public. The edge is not knowledge. The edge is obedience under pressure. Most traders sabotage themselves in real time. They hesitate at the level they plan to enter. They chase after price leaves. They move stops. They exit early. Then they review the chart later and say, I knew it. Knowing is cheap. Execution is expensive. Now let's break down what execution mastery actually looks like. 11. Enter when it feels uncomfortable. If an entry feels too obvious, it's probably late. Retail traders wait for certainty. They want confirmation candles, momentum, agreement from indicators. Institutions enter when retail traders hesitate. That hesitation is not random. It's emotional resistance. In 2026, entries will feel increasingly uncomfortable because algorithms are designed to probe emotion before expansion. If you can only enter when you feel safe, you will enter at the worst time. Professional execution happens before comfort, not after it. 12. Stop chasing confirmation. Confirmation is what you seek when you don't trust your framework. Every extra confirmation increases delay. Delay increases risk. Risk increases emotional interference. Institutions don't wait for confirmation from price. They anticipate behavior. Retail traders wait for proof. By the time proof arrives, price has already moved. In 2026, confirmation-based traders will consistently buy highs and sell lows. Anticipation, when structured, outperforms reaction. 13. Accept missed trades without emotion. Missing a trade is not failure. Chasing after missing one is. Most traders turn one missed opportunity into 3 bad trades. That behavior destroys accounts. Institutions miss trades constantly. They do not care. Another opportunity will come. Retail traders feel entitled to moves. In 2026, opportunities will be fewer but cleaner. Missing one will not ruin your year. Chasing one might. 14. Execute once, not multiple times. Over execution is as destructive as under execution. Entering multiple times on the same idea because price is fluctuating is emotional behavior. Professionals commit once, size appropriately, and manage. Retail traders nibble, add, reduce, re-enter, and turn one idea into chaos. In 2026, clean execution will outperform clever execution. One idea, one entry, one management plan. 15. Stop watching lower time frames after entry. Lower time frames exist to sabotage patience. Once you enter, lower time frame noise becomes emotional poison. Every tick feels important. Every candle looks like information. It's not. Professionals execute on one time frame and manage on a higher one. Retail traders enter on one time frame and then emotionally manage on a lower one. That mismatch causes premature exits. In 2026, screen addiction will be a major performance killer. Distance improves discipline. Execution fails when size is wrong. Most execution mistakes are size problems in disguise. You hesitate because size is too big. You exit early because size is too big. You move stops because size is too big. Professionals size so that execution is calm. Retail traders size so that execution is exciting. Excitement is expensive. In 2026, volatility spikes will destroy oversized accounts quickly. Size for composure, not for profit fantasy. Accept that some good trades will lose. Execution collapses when traders try to avoid losses instead of managing them. A good trade can lose. That fact must be accepted emotionally, not intellectually. If you cannot accept a clean loss, you will hesitate on the next good setup. Hesitation leads to chasing. Chasing leads to overtrading. In 2026, emotional debt will compound faster than financial debt. Clear acceptance prevents both. 18. Stop adjusting mid-trade. Mid-trade adjustments are usually fear reactions. Unless structure changes, nothing changes. Professionals do not renegotiate with the market. Retail traders negotiate every candle. In 2026, mid-trade micromanagement will cap profitability more than bad entries. Define rules, obey them, accept outcomes. Execution is a reputation you build with yourself. Every time you hesitate, chase, or flinch, you damage trust with yourself. Every time you execute cleanly, you rebuild it. Confidence does not come from winning. It comes from consistency of action. In 2026, traders with strong self-trust will outperform smarter traders with weak execution. The market exposes hesitation mercilessly. Execution must be boring. If trading feels exciting, you are doing it wrong. Professionals are bored most of the time. Retail traders are stimulated all the time. Stimulation kills discipline. In 2026, the most profitable traders will look inactive. They are not lazy. They are selective. Now let's anchor this chapter. Profitability is not lost in analysis. It is lost in execution moments. If you fix execution, most strategies work. If you don't, none will. If you are still looking for excitement in trading, you are not ready to be profitable in 2026. That statement alone offends most traders, and it should, because the need for excitement is the silent killer of consistency. The market does not reward adrenaline. It rewards precision. It rewards patience. It rewards obedience to process. By the time you reach this stage, you must understand something very uncomfortable. Most of your losses are not caused by lack of knowledge. They are caused by lack of discipline around what you already know. You know when you are forcing trades. You know when you are entering without confirmation. You know when you are trading because price is moving and not because your model is present, and yet you still click. That is the real problem. Profitable traders in 2026 will not be smarter than you. They will simply be more controlled than you. Precision begins with time, not price. If you are trading every hour of the day, you are gambling. There are specific windows where institutions do business. London Open, New York Open. Specific kill zones where liquidity is engineered. Outside those windows, price is often random, corrective, or algorithmically muted. Trading outside your window is emotional trading disguised as more opportunity. It is not more opportunity. It is more exposure. A trader who only trades one window a day already has an edge over someone who trades all day. Why? Because fewer decisions mean fewer emotional mistakes. Fewer decisions mean clarity. Clarity produces confidence. Confidence produces patience. In 2026, profitable traders will ruthlessly restrict when they trade, not because they can't trade more, but because they don't need to. Next is model consistency. You cannot trade 5 models and expect mastery. You cannot switch strategies every month and expect confidence. The market does not reward versatility at the early stages. It rewards specialization. One setup, one narrative, one execution style. That is enough. You do not need to catch tops and bottoms. You do not need to predict the entire move. You need to participate in the portion of price action where probability is skewed in your favor. If your model requires perfect entry, it is not a model. It is a fantasy. Profitable traders in 2026 will stop looking for perfection and start looking for confirmation aligned with bias. Bias comes from higher time frame narrative. Execution comes from lower time frame displacement, imbalance, or structure shift. Risk is defined before entry. Targeting is logical, not hopeful. Hope is expensive. Another critical change is risk standardization. If your risk changes based on emotion, you will never scale. If you risk more after wins and less after losses, you are letting your emotional state determine position size. That is not trading. That is impulse behavior. Every trade must risk the same percentage. No exceptions. Not the same stop size, the same account risk. That consistency does 2 things. First, it stabilizes your equity curve. Second, it removes emotional attachment to individual trades. When risk is fixed, outcome loses power over you. And when outcome loses power over you, discipline becomes natural. Now let's talk about journaling, because most traders lie to themselves about this. Screenshots are not journaling. Writing loss because of news is not journaling. Journaling is brutal honesty. Journaling is documenting why you broke rules. Journaling is identifying patterns of self-sabotage. You are not journaling to feel productive. You are journaling to expose weakness. In 2026, profitable traders will treat their journal like a mirror, not a trophy case. They will track why the trade was taken, whether rules were followed, emotional state before entry, emotional state during drawdown, emotional state at exit. Over time, the journal reveals something painful. Your edge is not your strategy. Your edge is how often you follow it. And finally, detachment. You must stop caring about being right. Rightness feeds ego. Ego feeds revenge trading. Revenge trading feeds drawdown. You are not paid to be right. You are paid to execute. A losing trade executed correctly is a success. A winning trade executed emotionally is a failure. That mindset alone separates professionals from amateurs. By the end of this stage, trading becomes quiet, boring, mechanical, and that is when profitability starts to appear. Not loudly, not dramatically, but steadily. When your emotions are no longer involved in execution, the market stops feeling hostile. It stops feeling unpredictable. It becomes a business environment governed by rules. And you finally begin to operate like a professional. Most traders are not defeated by the market. They are defeated by time. They burn out. They lose confidence. They abandon systems that were never given room to mature. They chase the next concept, the next mentor, the next promise of certainty. By 2026, the traders who remain profitable will not be the most aggressive. They will be the most sustainable. Sustainability begins with accepting a truth most people avoid. You are not here to make money every day. Daily profit addiction is one of the most destructive mindsets in trading. It forces overtrading. It forces low quality entries. It turns flat days into emotional failures, and it creates pressure where none should exist. Professional traders think in weeks and months, not days. A flat day is a win if rules were followed. A no trade day is a win if conditions were not present. Doing nothing is often the most profitable decision available. If you cannot sit on your hands, you cannot scale. Longevity also requires redefining what success looks like. Success is not hitting a big trade and disappearing. Success is repeating small edges hundreds of times with discipline. It is protecting capital during bad weeks. It is reducing drawdowns faster than you increase position size. In 2026, profitable traders will obsess over drawdown control, not profit screenshots, because profits are loud. Drawdowns are silent killers. One uncontrolled drawdown can undo months of disciplined work. That is why professionals reduce risk during periods of inconsistency. They don't push harder. They pull back. They protect the account first. Capital preservation is not fear. It is intelligence. Another element of longevity is lifestyle alignment. If your life is chaotic, your trading will be chaotic. Poor sleep, emotional stress, unstable routines all leak into execution. Trading magnifies who you already are. That is why serious traders build boring lives. They trade the same hours. They review at the same time. They eat, sleep, and exercise consistently. They remove unnecessary drama from their environment. Discipline outside the charts creates discipline on the charts. And then there is identity. You must stop seeing yourself as someone trying to be profitable and start operating as someone who already is professional. Professionals do not chase. They wait. They do not argue with price. They respond to it. They do not feel entitled to trades. Entitlement is deadly. The market owes you nothing. Not because you studied, not because you lost yesterday, not because you need a win. Once you accept that, pressure disappears. Another critical shift for 2026 is detachment from social validation. If you trade to post results, you will eventually lie to yourself. If you trade to impress, you will over leverage. If you measure success by likes, you will sabotage consistency. Profitable traders trade quietly. They don't need applause. They don't need confirmation. Their confidence comes from execution, not attention. And finally, trust, not blind trust, earned trust. Trust built from repetition, from thousands of chart hours, from journaling, from seeing your edge play out over time. When trust is present, hesitation disappears. When hesitation disappears, execution becomes clean. When execution is clean, results become consistent. That is the final evolution. Trading stops being emotional warfare and becomes a structured process. Wins no longer excite you. Losses no longer disturb you. You are stable, and stability is power. By 2026, the traders who survive will not be the loudest, the fastest, or the flashiest. They will be the calmest. They will be the ones who mastered themselves before trying to master the market. And that is the real edge.